Best 3x leveraged ETFs. This is your investing questions answered by Jason Kelly. If you'd like to record a question to be answered on a future episode, please leave a message at 310-734-8889. Since the Kelly Letter launched its 9 Sig plan 6 years ago using ProShares Ultra Pro QQQ, that's TQQQ, as its stock fund, the ETF has become the most popular 3X vehicle on the market. According to the ETF database, TQQQ's daily average volume is more than 199 million shares. That's more than the 81 million averaged by the Spider S&P 500 Trust, SPY, which is the world's largest ETF by assets at $357 billion. TQQQ has only $14 billion. Its relatively low assets but enormous volume show that it's a favorite among traders, not long-term investors. The way I use it is a hybrid, as subscribers know. It's a key part of 2 of my long-term plans, one for growth and one for income. The plans abide by a set of rules based on the fund's quarterly price change, trading at once per quarter depending on where its price went. If TQQQ declined a lot, then 9 Sig buys a lot. If it declined a little, 9 Sig buys a little. It works similarly in the opposite direction. If TQQQ rose a lot, then 9 Sig sells a lot. If it rose a little, 9 Sig sells a little. This process of automatic reaction to price change works with all stock funds, by the way, not just leveraged ones. I use it on iShares Core S&P Small Cap, IJR, which is a non-leveraged fund, and also on ProShares Ultra Mid Cap 400, MVV, which is a 2x leveraged fund. A question I receive frequently, and did again last week, is this. Would a broader-based 3x fund be safer than TQQQ? This is presumably in reference to TQQQ magnifying the daily price change of the NASDAQ 100, an index that is heavy into technology stocks. Its top 5 components by weight are Apple, AAPL, Microsoft, MSFT, Amazon, AMZN, Google, GOOG, and NVIDIA, NVDA. These 5 stocks alone comprise some 42% of the index. So it's easy to see why the NASDAQ 100 is considered a mega tech proxy. Therefore, reason some investors, it's not as suitable for long time horizons as a broader based index such as the S&P 500, which is followed at 3x leverage by ProShares Ultra Pro S&P 500, UPRO. Another group of investors suggests that even more focus is needed to really crank up the volatility. For example, a 3x leveraged tech sector fund, such as Direction Daily Semiconductor Bull 3x shares, SOXL. Let's look at that. Let's just look at these 3 funds together. Because while both UPRO and SOXL, that's UPRO and SOXL, would work in the 9 Sig plan, TQQQ hits the performance sweet spot. That's no coincidence. Of course, I researched all the options before settling on TQQQ and presented all that in detail to subscribers. And I've been pleased to see over the last 6 years since it started, that the backtesting has held up just fine in real life, which is what you would expect, but it's nonetheless gratifying to see. It does hit that sweet spot. So let's go through why. TQQQ provides plenty of volatility, but some diversification beyond tech, making it less vulnerable to a multi-year single sector struggle. UPRO isn't as volatile as TQQQ, making it less useful to a plan driven by higher highs and lower lows, which it exploits. The 9 Sig plan exploits in the rules that automate selling and buying such conditions respectively. And those are the rules that I talked about earlier. Here's the price change of these 3 funds we're looking at in 2022. So that's last year's bear market. 2022 price change in percent. UPRO down 57.0, TQQQ down 79.2, SOXL down 85.8. Some would glance at that or hear that and wonder why in the world anybody would touch these funds. But if you run a plan like 9SIG that signals buying into such times, those minus signs are not warnings, but invitations. Before moving on to that, notice that all three provide plenty of downside for bargain hunting. Yes, SOXL dove deeper in 2022, but not much deeper than TQQQ. And even UPRO went plenty deep enough for bargain hunting. You can see why any of these funds would work in a plan that craves volatility. Now let's move on to why they are good for long-term plans. On top of delivering years like 2022 for packing the stock side of a plan, they deliver rising stretches like the following for harvesting profits. 2019 through 2021, so a 3-year stretch of price change in percent. SOXL, 1,125.4. TQQQ, 798.2. UPRO, 338.6. Next, let's take it all the way back to 2011, the first full calendar year in which all three funds operated. Here's how they performed from there to the end of 2021. 2011 through 2021, price change in percent. TQQQ, 10,701. SOXL, 8,094. UPRO, 2,576. These are great tables to share with your friends who insist on repeating the canard that leveraged funds don't work over long time frames. Try telling that to anybody who bought one of these at the end of 2010 and held it to the end of 2021. SPY's price change over that time frame came nowhere close, 278%. The three tables also demonstrate why my plans prefer TQQQ. That fund runs circles around UPRO in the long-term appreciation department and outperforms SOXL as well. I would characterize it as the most evergreen of the big performers. When stocks head south, it provides a big enough bargain to recharge my 9SIG plan for the next recovery. Maybe not the biggest, but big enough, particularly when combined with its superb long-term return. I would suggest that the worst choice of these three funds is UPRO. It doesn't appreciate as much in most time frames, and when it goes through a bear market like the one of 2022, it falls enough to cause despair in anybody who's not comfortable with the way they're using it. If it's volatility your plan requires for top performance, then going with higher volatility makes sense. This is contrary to what mainstream financial media will tell you, but it's the truth. If you can't handle a minus 79% year, you probably can't handle a minus 57% one either. A non-leveraged fund or even non-stock fund might be better. For my 9SIG plan, I'll stick with TQQQ. Thank you for listening. This is Your Investing Questions answered by Jason Kelly. To record a question for a future episode, please call 310-734-8889. You can subscribe to the podcast from any of the links at jasonkelly.com to Apple Podcasts, Spotify, and other platforms. And please don't forget to subscribe to the Kelly Letter. Prices are still low, but the market has been rising at the start of 2023. You'll want to put these low prices to work for the next big recovery like the one I just showed when looking back over more than a decade. Please become a Kelly Letter subscriber today at jasonkelly.com to start your own market-beating SIG plans, including the TQQQ Harnessing 9SIG plan I discussed in this episode. Current subscribers, as always, thank you for doing business with me. I will see you Sunday.